I try to put too much stuff in a class. But anyway, let's go ahead and pull up. So you should have got this in your email. It's also in Blackboard. And this is kind of wrapping up the stuff at the end of the audit. Okay, so end of the audit procedures. One of the really big things that you do at the end of the audit is you have a management representation letter that you hand to management. It needs to be signed by the, why should I put that in there? It's usually signed by the CEO and CFO or their equivalents, whatever they are. So the CEO's Chief Executive Officer and the Chief Financial Officer. And so those are the two that are required to sign this management representation letter. Now, this management representation letter, it does not replace auditing your audit testing and evidence gathering. What it's there to do really is to sort of remind management in some ways that, you know, they're responsible for basically everything in the audit. So if you go, as you go through here, now a lot of this, there's a lot of stuff in here, but and a lot of it is kind of common sense. Let them know that they're responsible for the financial statements. The auditors are not responsible for the financial statements. We're responsible to give an opinion. All right. All financial records are given. Directors' minutes, the meeting of the directors, they should all be there. A lot of times, the auditors will sit in on directors' meetings. You see in directors' meetings, they'll have the directors all at the table. You see some people in the background wearing suits with notepads. Those are, you know, usually lawyers and CPAs that are there for, you know, they'll sit right in on the board of director meetings. You know, they've given you all the information. Basically, all this stuff is about they've given you all the information that you need. You know, that there's no unrecorded transactions. This one is, you know, the net effect of uncorrected misstatements is immaterial. That, you know, that's basically saying that there's nothing material that is in the misstatements. And by the way, you know, you do always hope to, you give them, if you do have any corrections that need to be made on the financial statements, anything that you need that is material, your real hope is that they actually do the corrections. But this is another thing saying that, look, that we say that all the misstatements, any misstatements that are still there are immaterial. Take responsibility for internal controls, related parties, blah, blah, blah. You can go through all these, but they're basically that you have all of the information from the company. So that's basically what this is about, getting all the information from the company. Oh, I goofed up my spacing here. And again, it's a very important part of the audit, but it does not replace any audit procedures. In other words, you're still required to get all the evidence and all that. You can't rely on this. You can't say, oh, well, management took responsibility for you know, contingent liability. You're still required to do all your same work that you normally do for any of those things. But you put this in front of management, and the hope is if there is something that they didn't give you, that it comes out. Well, you know what, we didn't, you know, we got this from the, you know, EPA or whatever. I don't know if you guys saw this or not, and then they give you the information. Okay, so you give them this letter, and the CFO refuses to sign the letter. So the chief financial officer says that they're not going to sign the audit. I was only hired on October 10th of this year. I'm not responsible for the entire year. So the CFO does not sign the letter. Which of the following is probably the most appropriate action? And I'll tell you that the AICPA would probably tell you there's two here that you could probably do.
Withdraw from the audit.
Yeah. One thing you do is withdraw from the audit. Say, look, if you guys aren't going to play nice, as a CFO, you are responsible for the financial statements. There's one more that they could give, though. One more thing they could do. When someone refuses to sign something like this, it does raise questions as to why. And, there's a lot of stuff in here. You don't know which one of these things they might not be, objecting to. It could be someone just being difficult, but it could also be that there's something in here that they don't want to attest to. So there is one more thing you could do.
Give a disclaimer of the opinion.
That is the exact answer we're looking for. Yes. First of all, you're not going to agree with the CFO. They have to sign it. If the CFO doesn't know if the financial statements are correct, then nobody does, or not materially misstated. You're not going to give an adverse opinion, because an adverse opinion means that you know the dollar amount. This means that the and you don't know, right? I mean, it could be any one of these things, or two of these things, or one you don't know. It could be 5 of these things or none of these things. You don't know why they do it. So you could also give a disclaimer opinion. Say, look, you don't sign it. We don't, that we can't be sure that, there isn't something in there that for a reason that you can't do it. So a disclaimer means you don't know. There's doubt there. So they generally have to sign the management letter. Could be a very unusual situation that, for example, I'll give you, let's say at the end of the year on January 20th or whatever, unexpectedly the CFO passes away, and you don't hand him this letter until March. Well, there's nothing you can do with that. So it could be there's an impossibility to it, but generally speaking, this must be signed by both of them, or else they get either a disclaimer or withdraw from the engagement. And we talked about this before. Withdraw from the engagement is kind of a risky move, because this is usually given at the end of the audit. So the next auditors coming in would have to, try to go back, and get the information that they need for inventory and all this other stuff. So probably the most reasonable one there would say, okay, well, either they sign it or you get an opinion, disclaimer. You get nothing. Either sign it or you get a big nothing. And so hopefully that will, get them to sign it. Okay. One of the things that happens is subsequent events. I think I'm going to time right here, I think. Focus my doggy picture. Yeah, it's a little too far off. Okay, so it's sort of like this. So we got this timeline. All right, so here is a 2021. We have a year end. That is say December 31st. So this is the year end. This is when the date of the financial statements. Okay, so here we're doing audit work. You may have done some audit work up here, but you're doing the audit over here. And do it up to the date of the audit. And we'll find out what that is in a minute here, the last date. But there's this time in between. So there's a time in between when you are doing the the year end and you actually issue the audit report. And that is when you can have what they call subsequent events. So these subsequent events are just for example, I'm going to try to keep it consistent what we have here. So this is a February, let's say February 22nd, I think I got here. No, 20th. No. 24th. Sorry about that. It doesn't matter. But anyway, so there's this time in here. So this is a subsequent event. Anything that happens in here. So a subsequent event is, let me get back to the, they come in two different flavors. So this is something that happened after year end. So these are events that happen after year end. And again, they come in two different flavors. The first flavor is subsequent event is so a type 1 event is something that existed at the balance sheet date. Type 2 event. Lazy copy. That did not exist at the balance sheet date. So back to this thing. So type 1 would be for something that happened here. Okay, it did not happen. It was on the books. It could be something on the books. It could be a loss contingency or something like that. But something was on the books at the time that now you have more information in this period after the year end. So type 1. Put it. Now, type 2. This is for only for really big things. Gosh, man. So this first one could be for just about anything. The second one is only for really big things, and I'll see examples of that. Now let's jump to the examples right now. Okay. So the client has a year end of 12/31. The date of the audit report is February 24th. And the financial statements are issued on March 1st. Okay. Okay, don't do that. The client announced a merger with a large competitor on January 27th. Okay. Did this exist at the balance sheet date of 12/31?
No.
So it is not going to be a type 1. Do you think it would qualify for a subsequent event type 2?
Yes.
Yep. Yeah, this would be a subsequent event type 2. It's a major thing. They're a large competitor. Now they're not competitors anymore. They're in the same business. So this would be a subsequent event type 2. Now, here's the thing, especially about this the subsequent event type 2. This happened before the financial statements are issued, right? So people are going to be reading these financial statements based on what was going on 12/31 before this was issued. Now, so they're going to look at financial statements that, kind of don't relate to the company anymore. This company might be twice as big now. And so they issue these financial statements that are not all that relevant, So here's what you have to do. You have to somehow, let them know, and you insist that they put this in the footnotes, and you'd probably put this in your audit report also, as we'll talk about it later, emphasis of the matter, and that you would say, okay, by the way, this company's twice as big now. They merged with whoever, and now they're twice as big. So these financial statements that were for, back when it was half the size, know that these these financial statements are for. They're they're not materially misstated as of the date of the audit, of the financial statements on 12/31, but they're not that relevant because of this new thing. I'm pounding on my table here, I'm shaking the camera. But anyway, so that's why you have to tell people about these subsequent events, especially if there's something large that happened. Say, look, don't expect this to be the way it's going to be in the future, because now this company is twice as big. Okay. Number 2, client had a lawsuit that was estimated, they had an estimated loss of 40,000 on 12/31/21. On February 12th, 2022, the case was settled for 36,000. What is this? Let me make it even a little more. Does it make sense to have this estimated loss on the books for 40,000 when you know that it was settled for 36? Hey, that's not a. Let's be a period. I mean, does that, financial statements have not been put out yet. So this would probably be more along the lines of a type 1. This would be, hey, we got this more information. It relates to something that was there on the books at the balance sheet date. We had this loss. They put this loss, on the balance sheet date of 40,000. They estimated it. Probably worked out with the attorney or whatever to see what the estimated loss would be, and then they end up selling it for 36,000. And again, notice that we're still working on the audit, so you might suggest to them, look, if this was material anyways, you may want to go in and change that to 36,000, which is actually what it was settled for. Put it in the footnotes. If it's not material, don't worry about it. Okay, coming down here. The client entered a union strike with an agreement on February 15th, 2022. I don't think I talked about this yet.
Type 1.
This would actually be a C, not a subsequent event. And I'll tell you why in a second here. If a company has a union, just a normal part of the operations are you have a union, you're probably going to have strikes or some kind of contract negotiations and things like that. This is just run-of-the-mill business stuff, and this is not considered to be a subsequent event. It's not going to be, it's not going to change the overall financial picture of the company, their overall financial structure, or anything like that. It's not going to be type 2. And as a type 1, again, this is something that is normal. It's a normal part of their business. If you have a union, that you could have some union negotiations and have strikes and that sort of thing. So this would be not a subsequent event. How about number 4? Client introduced a new product that could revolutionize the industry on February 2nd, 2022.
Not a
Type
substitute.
2.
This would actually be not a subsequent event. Companies, make new products all the time. It may be a revolutionary one, but it's companies making new products all the time is a further natural core of their business. So not subsequent. So subsequent event are usually for those things that change the company significantly financially, and usually has to do with their financial structure. It could be other things too, but there are going to be things that are significant to the financial statements, and that it changes what the core of the business is for it to be a type 2. All right. And normal things, strikes, new products coming out, you get a new president, something like that. While those things might have an impact on the company, there are also things that are fairly run of the mill that any company would have. So we're not looking for things that are normal to the business. And not to put like too much of a spin on it too, but you look at something like companies that make fireworks or something like that. People say, well, they got to put this on the books that they make fireworks and fireworks are dangerous and all this. Everyone knows fireworks are dangerous. If you've invested in a company that making fireworks, it's not news that they're dangerous. So you don't put that generally in the financial statements. Anyone investing in that company, the same thing with the auto companies. People make automobiles. People get killed in automobiles every day. What do you put on the books for that? You don't. People investing in auto companies should know that part of automobiles is that people crash them, and that you don't put anything on the books for that, especially like in things like the subsequent events or things like that. Those are called like general contingencies of running a business. Yeah, something bad could happen if you're making fireworks, but that's part of the business of making fireworks. Okay. A few things here. Any question on that thing? And again, the type 2 one really has to be something that changes the business significantly. The business is not the same as the business that was there before. Going into the future for the next however many years, it's going to have a major impact on the business. Okay, date of the audit report. The end of the audit report is the last day of field work. It's also the last day that the auditors must actively search for subsequent events. Oops. Missing letters there. So up until the last day of field work, the date on the audit report, they are still actively looking for subsequent events. They have to actively look for things that are happening to the company, type 1 or type 2 events that they need to make note of. They're either on the financial statements as of 12/31, or things that are so major that you got to tell the reader, look, this is a different company than it was before. It's going to be different. Okay. The report release date. Oops. This is the date. Financial statements are released. So you turn in the audit on, well, I can do down here. I can show you. For instance, hit down here, we have the audit date is the 24th. And the release date is March 1st. So we give them the audit report on February 24th, and then on March 1st, they release the financial statements with the audit report. Okay. Now, date between the date of the audit report and the release date I should write this different. The time between the auditors should passively search for subsequent events. Oops. So it's basically anything that comes to their attention. Oops. So it's anything that comes to their attention. Okay, so it's considered passive. And you're looking for anything that comes to their attention. So they're not actively looking for something, but if it comes to their attention, they're passively looking. In other words, they're not going to ignore everything that comes to their way, but they're not going to go searching for it either. So if they're reading a newspaper or something like that, and there's some event in there, and actually that actually happened to a friend of mine, I'll talk about it in a second, but so they're passively looking for those events. So let me do something here. Go back to this thing. So it's sort of like this. For subsequent events, they must actively look here. At this time up until February 24th, they're looking for events. Now, the time between February 24th and March 1st is going to be passively. Oh, I erased the whole thing, but underneath that somewhere is passively. So actively looking up until that date of the audit report, and they're on the hook for anything up to that date to find it. After that date, it's only passively. And if it comes to their attention, they're responsible. If it doesn't come to their attention, they're not responsible for it. So there's that kind of strange time in between those two that the financial statements are not out, but something could happen. All right. Now, let's see here. Okay. So this is the example. Cool. Okay. So the date on the audit report is February 24th. The release date is March 1st. Okay. March 28th, the client reached a settlement with a large investor for a material amount. The settlement qualifies as a subsequent to event. All right. We had A, B, or C?
B.
Okay, February 28th. Yep. So February 28th is between, it's after the end of field work, so they don't have to actively look for it, but they are passively looking for it. And by the way, just I had a friend who was it was like one of his first audits he was on, and they were delivering the audit report to the client. So they're driving over in the car, and the manager sitting in the back reading the newspaper, and he looks up and says, "Turn around, we got to go back." You read in the newspaper that they had a merger. The client they were going to deliver this thing to had this merger go through, and they hadn't heard about it or talked to them about it. And here it was, like in the Wall Street Journal or something, that they had this merger. And so they had to turn around, go back to the office, and figure out what was going on with it. But yeah, that's it's kind of a crazy example of it. Okay. On March 8th, the client's only warehouse was destroyed by fire. The warehouse fire qualifies as a type 2 subsequent event. Okay, so
B.
yeah, actually there's two here I made this knowingly. They're not responsible to update their audit report. That's true. This one is also true though. If they find out about it, where is it? Something different here. That if they find out about it, they have no immediate reason to update the report. But if these financial statements are reissued, and they could be reissued with the next quarterly reports, they could be reissued with the next year's reports, that you probably would want to update your report to include this fire. So something that happens after the date, you're not responsible for it. And and the idea is people say, well, why don't you just change it to March 8th? You'll never get the financial statements out if you keep doing that. So you're not responsible for it. If the audit report is subsequently released later on after the date, whether it's for a specific bank or something, or whether it was for going into next year's audit, they're going to want to release both sets of financial statements together. Then you want to update your report to include, oh, by the way, there was a big fire on March 8th. Okay, but absolutely correct. They are not responsible to update their report. It's after, and looking for it has nothing to do with it because it's after the issue date. Okay, some of the stuff is, well, actually dual dating is a little bit interesting. So here's, let me show you something. When you do run into a subsequent event, so when you run into a subsequent event, like the one they ran into on the 28th. On February 28th, they ran into the whatever that, I forget what it was now. So this thing, they had the settlement on the 28th, right? When you find something like that, you now have a choice to make. Because if you include that in your report, you must do one of two things. Either extend the last day of fieldwork to February 28th, which means you have to then actively look for that time between the 24th and 28th. Or you could do what they call dual dating, which is what we're going to talk about next. So dual dating is when a subsequent event occurs. I keep forgetting the B in that. Dual dating audit report. This is very common. So in a subsequent event, they maybe have more than one date. And so dual dating is when they have more than one date. And what they'll do is they'll have the same date of, in this case, February 24th. That's the last day of the field. They'll say, oh, except for note Z or whatever note it is, we'll have a date of February 28th. So only that one item will be included in there, February 28th. So when a subsequent event occurs, you can use more than one date on it. Say, okay, just for this one item, it's this date. For everything else, it's the 24th. And the reason being is, again, this audit may never end if you keep having to update your last day of fieldwork. I've seen audit reports that have had 6 of these dates on there, 6 additional dates. And you can just imagine financial statements would never come out if you had to stop and redo the audit up until that date every single time. It would just become a nightmare. So dual dating is used a lot, and it's used because they have to get these financial statements out. So then they run into something that's unusual, the subsequent event, they'll put it in there and they'll say, okay, by the way, this happened. And they'll say, so everything is at the end date of, in this case, the 24th, but these things that happen subsequent, these are just for these items. We didn't look at anything else. We came across these items, that's it. Okay. So, yeah, dual dating is actually, that's something that is used a lot. And if you look at audit reports, maybe I'll pull up an audit report later and show you that almost all companies have them. These, well, for whatever reason, they have these, large companies especially will have, it's not unusual to have many of them. Okay. Communicate misstatements to management. So at the end of the audit, you will tell them what the misstatements are. They'll tell you to tell all the misstatements. Auditors usually don't do that. Certainly, material misstatements must be communicated. Oops. Immaterial misstatements may be communicated. It kind of depends on the client and the size of the, whatever they're looking at. Because there are some people that'll say, well, look, whatever you find, even if it's not material, tell us about it because I want to make a correction. I want to have the financial statements up working, whatever. So, it's not unusual to have someone say, give me all the misstatements. I know some of these are material, but I also want the ones that are immaterial. So I want the financial statements to be correct, and maybe we can learn something from it or whatever. So the material misstatements must be communicated, and hopefully, if there are material misstatements, they will make the appropriate corrections to them. Immaterial ones may. I can tell you that from the audits that I worked with external auditors. I was the internal auditor, but they used us for doing a lot of their stuff. They only communicated the material stuff. They did not, put the immaterial stuff out there. So anyway, all right, review of the engagement. I think we talked about this already. Quality control. The audit reviewed. Oops. I think we talked about this before too. AICPA. So quality control requires that the audit is reviewed, and we mean by reviewed is usually by somebody who is independent of the audit. And AICPA, it may be issued after, it may be completed after the report is issued. Must be PCAOB must be completed before so AICPA says you can do it after. PCAOB for issuers must be complete before. So review of the engagement, usually done by somebody who is independent of the audit. Someone who knows what they're doing, but they are independent of the audit. Okay, opinion and report issuance. Oops. Auditors required to give an opinion or okay. So report. So auditors are required to give an opinion or reason why you can't give an opinion. So a disclaimer is one of those things that is a reason why you can't give an opinion. It's kind of funny because they always talk about types of opinions, and one of they always throw in there is this disclaimer. But in truth, a disclaimer is not an opinion. It's saying we don't have an opinion. We don't have enough information to give an opinion. Okay, so yeah. So anyway, so you have to give an opinion or reason why you can't. Okay, here is one that is, oh, I thought I had multiple choice on this one. I don't. Suppose there's a conflict between the financial statements and stuff that is in the client's annual report. So the client releases the annual report with your with the financial statements in, and it's going to have your audit report will be in there. I should put a little more in here. The conflicts are between the financial statement. Oh, between the financial. Okay, got it. So anyway, so let's say that for example, let's say that their sales are whatever $312 million. You read through their annual report, and they talk about that they have sales of $340 million. So 312 million is in the financial statements, but in the audit, in the annual report that they release to people, that is like kind of like a magazine, a big, they say 340 million. Okay, well, that is a conflict between what is in the financial statements and the annual report. The question is, what do you do when you come across that? And there are a couple of alternatives you can do. You can, one, withhold the audit report. Made. Two, withdraw from the audit. Kind of a and lastly, I'm going to get a little more space up here. Oops. You could add it to the audit report. And the idea is hopefully they will correct the annual report. Okay, let's take a break. How about starting on chapter 18. Let's say be back at let's say 7:10. I guess I didn't need to say 7 p.m. But okay. All right. Okay. So chapter 18 is all in the audit reports. We've covered this a little bit, but basically everything in auditing culminates in the audit reports. So anything you find in auditing, it all comes down to that audit report and what your opinion in that audit report. And there is the standard opinion, which is the clean opinion, now called the unmodified opinion. And I don't know if I told you this before, but back in my day, sometimes on the CPA exam, they would just tell you to write it. So, this audit report, they would just say, write the, standard, and back in those days, it was called unqualified, the standard unqualified report, and they would expect that you had memorized it and you could write it. This is a little bit longer than one we had. Yeah, a couple things added to it. But basically, that's what they used. I don't think they've done that for years. But when I was going through that, and you would study because you never knew if that question, you'd memorize it because you never knew if that question came out. That if that question came, if you memorized it, and that was on the CPA exam, well, you're pretty much guaranteed you're going to pass the auditing section because you knew half the people weren't going to get it. And so even unless you did something completely insane on the rest of the test, if they put that on there and you memorized it, you probably pass it. So when I took it, it wasn't there, but I memorized it in case it was. Well, I'll tell you one of the weird stories though is that I used to, if you were in my auditing class back then, I would not make you, but part of it would be write that unqualified audit opinion. And the reason being is that, to get you, to give people, some idea of like taking the CPA exam. And also there's a lot of stuff in those opinions that if you know the opinion very well, it actually helps you throughout the exam. And we'll talk about that in a minute here. But I'll tell you kind of a funny one is I would tell students this, and I would go over the unqualified audit report. And the first day of class, I was telling them about, okay, this is the audit, you got to memorize this. And, whenever you're ready, you can just write it. And, it's 10% of your grade and blah, blah, blah. So we go to break and one of the students stays back and says, can I write the audit report? I just gave it to him. It's, this. And I said, well, there's no way, yeah, I can write it. I can write it. So I gave her, I didn't even have the report with me. So I said, okay, just take out a piece of notebook paper. She took out a piece of notebook paper and she wrote the thing verbatim. Strangest thing, one of the strangest things I ever saw. But anyway, I asked her about it. She said, yes, where she came from. She came from she lived in the mountains. I think it was either in southern Mexico and something like that. And they didn't have much money. The schools and all that didn't have much money. So they had a few books. And so they would memorize the chapters so they could take the test. And so they would memorize, they all get around and go through the book and memorize it. And she could just memorize it. And I told her, you picked the right field because, memorizing is, for taking the CPA exam is, if you can do that, I mean, that's amazing. Okay, we talked about this before. Yeah.
With the CPA exams, is it all multiple choice or you have some written sections of the CPA exams?
They do have some sections that are written. The exam is changing considerably in 2024. So the way it is right now, yeah, you're taking multiple choice questions, and there's also what they call simulations. And the simulations are, a lot of times they're drop down boxes and things like that. There are also some calculating, putting numbers in, things like that, but they are not as much as writing out completely, the sentences like we used to do.
Oh, okay.
Yeah. So it's a different kind of test. It's really getting changed quite considerably in 2024. I'm not 100% sure why they're doing this, but it doesn't really matter. But they're changing it so that you'll take the test and you'll choose one of three paths. And the paths are auditing, taxes, and consulting, basically. So those are, and so you might, so your CPA exam will be dependent on which one of those you choose. I know that sounds very strange, but that's what they're going to. I'll tell you, back in my day again, they used to always they would a lot of times give us choices. So they give us, let's say that they had 3 problems. They would say, okay, here's this problem. And then for this third one, you can choose either this problem or this other problem. They give you a choice. So you kind of did have this, thing that if you were good at taxes, you'd pick the tax problem. If you're good at something else, whatever. They used to do that on the exams a lot when I was going through, and they stopped doing that. But now it sounds like they're going through, but instead of giving you the choice on the exam, you make that choice ahead of time, and then you get a different exam depending on what areas you pick. And here's the weird thing too about it. The license doesn't change. It's still the exact same license. And it doesn't make you an expert in that area. It's just, I guess you just pick whatever your strength is and go with that. But yeah, so the exam's changing quite a bit in 3 years. But right now, the way it is set up now, that it's multiple choice and what they call simulations. Okay.
Oh, okay.
Back in my day, there was all written. you couldn't have no calculators. You couldn't have a calculator watch or anything like that. Kind of odd. You talk, let's use calculators. Oh, when did you take it? Like in 1942 or something? No, it was 1991, I guess. Okay. A few things. We talked about this, I think, in the past. The independent audit report is to the board of directors or shareholders. It is not to management. It's inappropriate to write this to management. Management made the financial statements. That's not who you're reporting this to. It's to people outside of the company. Your audit report gives credibility to what management is putting out as the financial statements. Okay, basic stuff. First sentence, they tell what they, what it's about, what did they do. We have audited. Manager's responsibility. This isn't a bad one to know. It's boilerplate. It's on every single report. Every single report coming out of the AICPA has this in it. That management's responsible for the presentation of the financial statements. They are also responsible for internal controls. So, they spell it out. This is every single audit report, no matter what the report is. It could be a report on whatever, a review. It could be a agreed upon procedures. It could be whatever, any type of report you can think of. They have this same thing for management responsibility. Okay, auditor's responsibility, and this first paragraph are these 3 things together. I broke them up just because for ease of use, but these would all be in the same paragraph. As an auditor, you have to express an opinion. It says, whose rules are you using? Are you using US rules or international standards? So whose rules are you using? And what those standards basically require. You get reasonable assurance about material misstatements. So we talked about this before. You don't get 100% assurance. We're doing sampling. You can get, as you guys know, fairly accurate based on the sample what the numbers are, where you don't have to actually go through every single item. And you're only looking for material misstatements. Things that are not material, you don't worry about. Okay, second paragraph. So the second paragraph is sort of an overall telling a little bit more information about what we do as auditors. A lot of people don't understand auditing. they think it's looking for, employees stealing stuff or something. Did an audit and they found employees stealing. That's not really what a financial audit is. Unless it's some crazy situation, it's almost impossible for a large company to have employees steal so much that it's material. But that's what a lot of people think, when you're doing auditing. But so you obtain evidence about the amounts and disclosure of financial and just they say consolidated financial statements if it's more than one company together. But you're basically there to get evidence. And they come right out and say, this is one of the most important things I think that they actually come out and put in. It's auditor's judgment. People think it's a science and it's not. It's it's an auditor's judgment of what they think it is appropriate to get the, to do an assessment of finding things that are material. And even what's material is, auditor's judgment. This is also new, and that is that it used to be that they were looking for misstatements, and now they say misstatements, and they come right out and say it could be fraud or it could be an error. We're looking for both. Back in my day, it was just we're looking for material misstatements. That's it. Whatever the reason, we don't say. But nowadays they say fraud or error in the AICPA one. This is this is the big difference between the audit report for in this case, a non-issuer and an issuer. In an issuer, they say the auditor considers internal control. You must get an understanding of internal control. But you do not give an opinion on internal control. For a financial audit, you do not give an opinion on internal control. Publicly traded companies must have an opinion on internal control. Privately held companies by the AICPA, no. And then they go even one further. Accordingly, we do not express such an opinion. So it says, not only don't we, you're not going to get we don't test to give an opinion, and you're not getting one. Which is kind of obvious from this, but they really drive it home. Okay, and look at the accounting policies, estimates, blah, blah, blah. This is also an important paragraph. This has always been an important paragraph. That is, we believe that our audit evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. Again, your opinion can only be based on sufficient, appropriate evidence. So it cannot be based on anything else. Can't have someone, management, sign the management letter. Oh, okay, the management, they signed this management letter, they take full responsibility. So that has nothing to do with your opinion. It is, your opinion is based on you get sufficient, appropriate, you get enough good evidence that you can make an opinion. And the opinion is pretty much the same as when I was going through. Oh, a couple things. This goes way back to like Middle Ages. Financial position is the same thing as a balance sheet. So you say, why don't they say balance sheet? Another word for it. Results of operations. That's pretty much the income statement. And you say, well, why do they say results of operation? Why do they say income statement? They don't, and their cash flows. So they pretty much come right out and say, what the financial statements they looked at are, and then they tell you whose rules we're using. So if it's the ones in the United States, principles generally accepted in the United States of America, GAAP. Firm signature, the entire firm is on the hook. The city and state. And we just talked about this, the last day of field work. So you're going to tell the CPA firm is going to sign it. what city and state they did, and the date, which is the last day of field work. They say, okay, up until this date, we were looking for stuff. I think it was February 24th on our thing. So up to February 24th, we're looking for stuff. And so that tells people, okay, they were looking for stuff up until February 28th. Now, the report may have been issued after that, and it usually is, but. Okay, the POC will be we talked about this, they have to be registered to do it. This one is actually fairly similar to the one that we would have to memorize. A couple things are put in there. This CASO thing wasn't in there, but the rest of this is, a lot of it is very similar to what we would be when I was going through. And you can go through it. A lot of it is fairly similar. Big difference is that they actually look at the internal controls. So they will actually do a internal controls. The one big thing that it is different is that they don't come out and say anything about fraud. They do say this: real assurance regarding prevention and timely authorization, acquisition, use of the company's assets could affect, have a material effect on financial. So they're talking about employee theft there, but they don't actually come out and say the word fraud as it pertains to management and their financial statements. It says we look for material misstatements, but there is no statement of fraud, which is a little unusual, but I don't know why, but that's the way it is. Okay. So we'll go through some of these opinions. And again, we did most of these before. So the standard report for a non-public client. So this would be the AICPA, the first one we looked at. Has everything except so if it's a non-public company. Anyone? Okay, it's this one. They don't give an opinion on internal control as part of a normal audit. They can do a separate one, completely separate, that's not required. But if it's a non-public, if it's a non-issuer, you do not have to give an opinion on internal controls. And if you think about it, a lot of small companies, they don't have very much internal controls. If they only have 4 people in the office, it's really hard to segregate duties. You know, so, well, you might say, well, why don't they do that? Why don't they be given a report on the internal controls? Well, for smaller companies, they may not have it. You know, so, you know, this is kind of goes along with the idea that non-issuers are oftentimes smaller. They can have really big ones, don't get me wrong, but most of them are probably smaller, and their internal control is not, you know, that's not their strong point usually, just because they don't have enough people. I worked at a small place one time that had there was 3 of us in the office. So there really wasn't any way to segregate duties too much, but you know, the owner was involved in it, so that's good. Okay, so standard report for a public company issuer has everything except just talked about it. He said it was unusual. Okay, you guys went out.
For management fraud.
Yep, very good. Yep, that's it. They don't come right out and say, we're looking for management fraud. They say management's responsible to protect the assets. That's employee theft, but that's not fraudulent financial statements. So, yeah, so that's a distinction that's made between the AICPA and the PCAOB. And I don't know why they may not put it in there because maybe they fear people would read it and think that there's management fraud when there isn't, but I saw in the report there's fraud, well, no, did you read the whole report? It says we look for that. It doesn't say there is any. Okay, so as far as reports are concerned, so the standard reports are the clean reports. Even if they're a clean report, they may have a couple of different things tacked onto it. And these things go on the end at the end of the audit, end of the audit report. So these are tacked on the end of the audit report. So the audit report will be exactly the same as we just looked at on pages on the first two things, the AICP and PCB. Everything will be exactly the same, and then they'll tack on these extra things at the end. Emphasis of a matter. These are things, I don't have it in here. Hey, who made this stupid thing? Emphasis of matter, right? This is kind of important. This is to emphasize. No, I spelled that wrong. Okay, emphasis of a matter. This is to emphasize something that has already been disclosed. So this is something that has already happened, that you're telling the reader, look, this is disclosed, in note whatever, but pay attention. This is important. This has been disclosed, and this is important. So emphasis of a matter means you're kind of what it says. You're emphasizing. Okay, look at this. Again, it's in the financial statements. It might be on the financial statements themselves, or it could be in the notes to the financial statements. But somewhere in the financial statements, there's something there that you want to tell the reader, look, pay attention to this. This is important. And one of the things that they commonly, or that they may have, is what they call a going concern opinion. This is when you believe the company is going bankrupt. So when a company is going bankrupt, you will insist that they put that in the footnotes to the financial statements. If they don't, they're going to get a bad opinion. So a going concern, you will tell them, look, it doesn't look like you guys are going to make it. You have to put that in the notes of the financial statements. And if they don't put it in the notes of the financial statements, then they get a qualified or adverse opinion. The disclosures are not correct. So going concern, doesn't want to come in and go bankrupt. Okay. So, okay, I'm sorry. Accept. So has all the characteristics of this except. All of these are correct, with the exception of one. So a couple things here. I'll give you the ones that are okay. First, is the issue when client will likely go bankrupt? That's true. The auditor may consider management's plan. That's true too. So if they have a plan, they go, yeah, I know things are bad, but here's what we're going to do. We're going to sell off this division. We're going to, negotiate our debt to, to a longer term. We already have it, in place. We're going to, if they have a real plan that looks like it's feasible, they don't need to have a going concern. There was an airline, maybe I've told you this already, old boring story, but there's an airline that was going bankrupt and they got a going concern, and they issued a statement saying, well, we got a going concern. We don't believe in it. That we're okay. By the way, we're selling this route, and we've sold 8 airplanes and all this stuff. They went through all this stuff, and the auditor said, well, if they had done that before, they wouldn't have got the going concern. So if they have a plan that looks like it is viable, you do take that into consideration. Must have a substantial doubt. Yep, that's exactly the wording you'll use, is that there's substantial doubt about them continuing as a going concern. Require statements. Yep. This is the one that is the exception. And the problem is here, within 1 year. The new terminology is at least 12 months or more. And or more means that if you think they're going to go bankrupt in 2 years or 3 years, that's enough. It does not have to be in the next 12 months, that it could be for a longer period of time, but it's at least, the time frame is at least 1 year. So, oops. So it could be more than a year. International standards are 2 years. So international standards, they actually come out and say 2 years. US standards say at least 12 months. Could be 2 years, nothing wrong with that. If you think they're going to go bankrupt in 2 years, that's enough to give them a going concern. Okay, emphasis of the matter is a generally accepted accounting principle not consistently applied. As which of those characteristics? Okay, so this is when they're using an accounting principle, but they switch from one to another. It could be because the auditors asked them to. The auditors might say, you really should be using FIFO instead of LIFO or whatever it is. So using FIFO for the inventory instead of say. Okay, so for instance, they go from one accepted way to another. You go from FIFO to LIFO, and the auditors may even have suggested, you guys should really be accounting for this in LIFO for whatever reason. So they're both GAAP. So it isn't that they're not following GAAP, they are, but they switch from one to another. Another thing is sometimes a new rule comes out. If a new accounting rule comes out, a brand new accounting rule, that wasn't there last year, well, you have to switch. Well, you probably weren't using the rule last year because it didn't exist last year. So this year, it does. So these are very common. These are very common. Okay, so it has which of the following characteristics? This first one, a change in estimate. So they changed the depreciation life. They have a piece of equipment that they thought was going to last for 5 years, and now they figure out it's going to last for 8. Is that a rule change? What do you think?
Yes.
Actually, it's not. For instance, if you're using the straight line depreciation, if you adjust the estimate, the method you're using is still straight line depreciation. So generally speaking, this one is not going to be a change in methods, right? You change from one gap to another. Just changing the estimate and okay, we think it's going to last longer or shorter or whatever it is. in accounting, you just, whenever you figure out it's going to be a different length in time, you just stop right there, and going into the future, you change it. You don't go back in time. Okay, so that one's okay. I should pull that one. Hey, I should have known that was going to happen. So it's not that. Is used if management adopts an unacceptable accounting rule. And by the way, these are tacked on to clean opinions. Now, if you think about it, if management's using an unacceptable accounting rule, they're not getting a clean opinion, right? So it's not going to be this one. If they don't, they're going to get a modified opinion if they do this one. This will be a modified, you know, qualified or a adverse opinion. Must be used even if the financial impact is immaterial. What do we do with things that are immaterial? That's right, we ignore them. This is the answer. And I just goofed up. Now I'm goofing up more. So even if the new rule is preferable, you still have to put it in there. So they say, wait a minute, we changed to a better rule. You know, this rule is a better report of our income or whatever it is. Or it's a new rule that came out, we have to follow it. That's fine, but it still goes in as an emphasis of a matter. They've talked about replacing this one. You'll find these in the the extra paragraphs tagged on to audit reports. You'll find these a lot. Because every time a new set of rules comes out, you know, they get these. So if a company has 3 new rules come out, they get 3 paragraphs tacked on their audit report. And there's some people that say, well, this is kind of confusing. You know, well, it's more information. It's also, you know, it also looks like they're doing something wrong when really they're not. Okay. Other matters. Other matters, these are auditor discretionary circumstances. And these are when this is something that has not been reported. So this is something that has not been disclosed in the financial statements or footnotes. Okay, so this is auditor discretionary. In other words, you can put these in. These are things that you can put in. Okay, other matter paragraph issued for uncertainties. Has which the following characteristics? Take a stab at it. Which one of those do you think it is?
Unusual uncertainty.
Which one?
C.
Yes. Very good. Yeah, unusual uncertainties are the ones that you're going to you know, put in here. Normal uncertainties of the client's business that, you know, whatever they are for the client's business, fireworks company and all that kind of stuff. B, if they can be reasonably estimated, they should be included in the financial statements already. You know, so if you can be reasonably estimate them, well, they should be in the financial statements already. You know, and is required, you know that that one is not right because these are discretionary. The auditor may or may not put these in. So if it's due to uncertainties, you don't put the normal stuff in. If they can be estimated, they should be in the financial statements already. And it's not required. If your judgment says that I'm not putting those in, put them in. Okay. Other matter or additional circumstances. This one is a little bit vague. And there's actually a couple of them here that you could probably put in. What's one of them that would probably go in there?
Is it D?
Probably not.
C,
Yeah, C would be one of those that would be, you know, likely. It is possible that you'd have A in there. This usually this stuff will be included in the footnotes, but if for some reason it wasn't, for whatever reason, you might put it in there, an important subsequent event. But yeah, you're telling them something unusual that happened. You know, oh, by the way, you know, if it's a hotel chain in, you know, I don't know, Florida or something gets hit by a hurricane. Oh, but by the way, you know, this isn't a normal hurricane season. You know, they lost 2 hotels out of their 5 or whatever. Okay. Oh, group auditors. I forgot about those. Running out of time. What am I doing here? Okay, group auditors. This is. Yeah, I gotta cover this, I think. You see me weighing the. And here's what a group auditor is. Suppose you have a big company. Okay, and they have audit firm A, right? That's their auditors. Okay, IBM owns small company. Subsidiary. They have audit firm B. Okay, now IBM owns a small subsidiary. There's auditor A, which is all of IBM, including small subsidiary. But you have auditors down here that are just doing the small subsidiary separately, right? So that, you know, they are their audit is only for the small subsidiary. This is called the group auditor. This is called the component auditor. So there's no problem for the component auditor. They have to audit this company and they give the audit report to this company based on their, on that. Now, this is all they're auditing. Audit firm A, though, has to have the whole thing. So here's the thing. Audit firm A includes this subsidiary, and they may have an audit report off firm, separate from that, a component auditor. So the question is, when they do the audit report, how do they account for this? No, not that. So the group auditor and the component auditor, the relationship. So what can they do? All right. So which the following is not true? Okay. Just looking at these. Okay, first one is true. They may decide to share the responsibility for the audit. So they'll put it in the audit. This is not allowed for international standards. International standards, you don't, the group auditor must not share any of the responsibility. They must have the whole thing. If the responsibility is not shared, they must do additional procedures. Yes, and this is, if you're international standards, this is what you have to do. Oops. This is the one that's not true. D is true. Ah, no, don't do that. Oh, man. All right, so this is the materiality for the group level and the component level are the same. That's no. This audit firm, their materiality is probably going to be much lower than this one. This one, $1 million might be very material to them. IBM is not. So the materiality level can be very different for a small firm versus a big one. And oops, I'm doing something stupid here. And also, you might have the small firm, the small company may get an adverse opinion, saying their financial statements are not correctly stated, or some kind of a modified opinion. What those are misstated by, let's say it's $1 million, might not be material to IBM, and that so IBM might get a clean opinion, even though the subsidiary got an adverse opinion, because materialities are completely different. So even though this little firm is misstated by $1 million, to that firm it's material, but to IBM, it may be not material. So even if they get a bad opinion, does not necessarily mean that IBM is going to get a bad opinion, because it might not be material to them. The entire subsidiary may not be all that material to them. Okay. We talked about this, I think. Is it the last thing? Yeah, I think we talked about all these though. Well, it's good to go over them again. I think one of the first or second days we talked about these opinions. Anyone remember for a qualified opinion? That's kind of like the medium opinion. A qualified opinion means overall the financial statements are okay, but there's a problem. So which one do you think it is? Oh, take a guess. Be wrong ones.
B.
It's material but not pervasive. So if there's a problem with one account, it's okay to get a qualified opinion. And the qualified opinion says, sometimes these are sometimes called except for opinions because they say everything's fine except for this one account. Adverse opinion. Adverse is the worst. Which one is it? Come on, you guys, this is the last chapter, the last class.
C.
The, yep. Material and pervasive. It goes through all the financial statements. This is also known as not GAAP. So these are not GAAP. The worst opinion you get. By the way, these opinions are rare because usually, well, first of all, especially these first two, the dollar amounts are known. So you give it to management, you say, hey, fix these. And if they don't fix them, then you, so these are actually pretty rare. And by the way, if they get one of these opinions, it makes things even look worse because you get one of these opinions and it says, okay, not only do you have bad financial statements, but you're trying to lie, so there is no benefit really to getting a qualified or adverse opinion. Qualified, there are times it can be helpful, but we'll talk about later. But the adverse opinion, there's no reason, that's just management being stupid, basically. Because it's going to be put in the audit report with the dollar amounts in it. Okay. Final material opinion. You're going to get a disclaimer of opinion. Unknown. Okay. I'm going to put one more thing in here, disclaimer of opinion. And this one, I doubt it comes up too much, but it does come up sometimes. What happens if the audit firm finds out they're not independent, or that someone on the audit wasn't independent? Okay, so you go do the audit and you realize, oh man, someone was on the board of directors the whole time, or you realize that someone was doing in the audit that had a direct investment in IBM or whatever. What do?
Do you withdraw from the engagement?
You can, if you are required to give an opinion, it's going to be a disclaimer. And the disclaimer is because you are not independent. So if you are, withdrawing from the engagement would be one, but especially if you are, if there's enough time, they can get somebody else in. But if you go all the way through and you find out later that someone was not independent, they get a disclaimer. It's not going to be a qualified or adverse because that indicates that there's something wrong with the client's financial statements. But you're saying, okay, these were actually audited by somebody who was not independent, and so they get a disclaimer. I can imagine there's going to be lawsuits flying for that. But yeah, so if you do end up with somebody that was not independent and they do give an opinion, the only opinion they give is a disclaimer. I have no idea how often that happens, but okay. And scope limitations, I'm sure I talked about this in the past. Scope limitation is when the client, well, it can come in different scenarios. Scope limitation is considered the most serious. So which one is the one that will make get you the maddest? So scope limitations, that's when you want to look at something, but you can't get it. So which one is the most serious? Which one's the worst?
C.
Yep. And this is one that they'll always, a lot of times you'll see this on the darn it. You'll see the number. You see this in a number of different ways on the CPA exam. But whenever you have a client that's not allowing you to get the information you need, not only is that you can't get the sufficient appropriate evidence, but when they block it, it also has the indication of that there's a problem with that area. These other ones, it doesn't indicate there's a problem. They had a fire. Okay, well, we had a fire. Or whatever. The auditors are hired after year end. Maybe the first auditor left the country or whatever happened. A lot of times these are not necessarily in the control of the client, whereas this one is the client, and it's the client not allowing you information. And by the way, whatever they're blocking, that's the information you probably want. If they won't let you talk to their lawyer, well, you really want to talk to the lawyer now. You wanted to before, but now you really want to do it. Okay. A scope limitation is deemed to be possibly material and pervasive. Should be given what type of opinion? Disclaimer. In other words, if you have no idea what's going on with it, they don't have any information on their sales. They can't give you records. They can't give you clients. They can't give you any, receipts of anything. Okay. It goes throughout the company and it's material or possibly material, and we have nothing. So it's a disclaimer. Okay. A scope limitation that is deemed to be possibly material, but not pervasive. So let's say that there's, their accounting, accounts receivable system. It kind of works, but it's kind of it's also has errors that you can see slipping into it. You've gone through it, you can't figure out what the errors are or why they're there or whatever. But it's not pervasive. Like the rest of the place is fine. The rest of the company, is doing okay. It's just these accounts receivable that you really can't figure out exactly what's going on with them. It's possible in those situations they get a qualified. And the qualified gives you a dollar amount, but you say, except for these accounts receivable, which we're really not sure what they have, everything else is fine except for the problem with the accounts receivable. So it is possible that you have a scope limitation that ends up getting a qualified opinion. And the reason is, as auditors, we try to give as much information to the readers as possible. And you just telling them, look, everything else here looks fine, but these accounts receivable we have no idea. But, you can rely on the inventory numbers, you can rely on the cash numbers, you can rely on, there's other things you can rely on. It's just these accounts receivable are just, you can't rely on them. So getting that information might be helpful to people making decisions, even though it's unmodified opinion, it's better than this, which is, basically a shrug. It's nothing. This is a tricky one. A scope limitation that is deemed to be not material and not pervasive should have which type of auditory opinion?
A.
Nope. Which
A.
one? Yeah, it's A. Yeah, if it's not material, if it's immaterial, this is kind of the kicker. Anything that's not material, this is a tricky one because, it's got this other stuff in there and it's a scope limitation. But if there's something that's not material, whatever it is, you have a a coffee fund is kind of a ridiculous one, but you know, if there's something that has a scope limitation, is not petty cash. You go to petty cash doesn't have any receipts or anything. You know, okay, well, you know, we can't find any receipts for these, but again, it's petty cash. It's not material. We're not going to do anything with it. That's probably a bad example because you wouldn't be auditing petty cash anyways. But the idea is if something is small enough, even if you can't get the information you want, but if it's small enough, you still get a unmodified opinion. Okay. Well, so let me pull up the stuff from last class. We'll try to figure out what we're going to put on the test. Wait a minute. There'll be something on accounts receivable confirmations, more general questions about when do you use them, positive ones, large dollar amounts, small number, negative ones. Probably not a lot in this area. Might do something on this. But are they required? They're required by US standards. They are not required for international standards to have confirmations. Probably put at least a few of these on, clearing them. The biggest thing you want to look for clearing these transactions. If it's a problem with shipping something, look for the bill of lading. If they've sent something back, look at the receiving report. If it's some kind of a payment that they should have, look at the checklist. So those are kind of the three documents there: bill of lading, or if it's something being shipped back to them, or receiving report. If it is a check that they claim they sent, you can look at the checklist. And again, there's some that maybe, put one like this on there or something like that. The ones that are basically, they think it's an error, but it's actually a confirmation. I'll put one of these out. Cutoff one. And this is, by the way, this is something like you would see on the CPA exam now. I'm not sure if they would have something, they may have something like this on the ones that are coming in the future, but they may have something like this. This is a cutoff. Basically, you're doing a cutoff on the bill of lading. So one like this, or like on the next page, the following one. We'll put one of those on there. So let's write this down. So we'll have something on positive, negative confirmation. I'm just going to call this the final exam. It's not really a final exam. We're not going to cover everything, but. And by the way, I think I mentioned this before, you wonder why we use a bill of lading more than the proof of delivery. A bill of lading at least proves that something was actually shipped. That the client, if it didn't show up at their customer, it's not because the client didn't ship something. They shipped something to them. It maybe didn't make it there, but they at least had the intent that it would be sent there. Okay, and the stuff from today. Let's think about what the stuff from today would really be. I'll put something in on a subsequent event. Something similar to what we have for these three. So I'll say subsequent event. Oops. So type 1 existed at the balance sheet date. Type 2 is after the balance sheet date. I don't know before that. Oh, okay, refuse to sign on. Date of the audit report. This is an important one. So I probably have something along the lines of that. Probably down here for the type of opinions. I'll probably be a little bit more specific in the type of opinions. I'll put a going concern opinion on it. And the going concern, oops. The going concern opinion is, I should say, paragraph. They call it an opinion. It really isn't. It's just a paragraph. It can be a clean report, and oftentimes it is. It'll look bad because it's they're going bankrupt, but a lot of times a going concern paragraph, you can be on a absolutely clean audit report, but they get this going concern paragraph saying, okay, by the way, this company, the financial statements are fine, but these, they're going bankrupt. That's going concern. Oops. And I'll give like maybe 2 or 3 on the opinion types of opinions. So types of opinions, the unmodified. Oh, by the way, unless they've changed it in the last year, they still call the PCAOB still calls them unqualified opinions. So if you see one opinion that's called the unqualified, it's the same thing as unmodified. Just look for the qualified, adverse. Ooh, what did I do? Uh-oh. Okay, Mark. Don't do anything stupid. Don't do anything. Last 5 minutes of the class for the semester. Adverse. And disclaimer, which is really just no opinion. They call it an opinion type, but it's really not. Okay. You know, that looks like too much stuff. Okay, let's vote. Of all these things, which ones do you want to get taken off? Something that looks like no fun to do.
I don't see it, but all the sampling stuff.
Well, then, yeah, no, sampling stuff's not going to be on there.
Oh, okay.
Of
Out of
these,
that list.
of these things, what do you want to get rid of? What things look like they'd be no fun to have on the test? Come on, how many instructors would do this?
Cutoff procedures
Thank you
using the
for that.
notes of leading and then positive and negative confirmation.
So this one, okay, this one, take that one off. Okay.
Someone can also say one. I just gave one. So
Maybe date of the audit report. That's what I would choose.
Okay, well, that one's kind of easy though. That one's just, I'll take it off. Basically, you're on the hook until everything. Okay, this will be it. Positive, negative confirmation. Clear the confirmation responses. So when someone sends a confirmation back that says, you know, I didn't get this order or whatever. So it's going to event type 1, type 2. Type 1 existed at balance sheet date. Type 2 is a brand new one. It's usually very big. Going concern or going bankrupt. And the types of opinions. Okay, that'll be a good test. 5 things. Okay, very good. All right, so that's what'll be on the final exam. I'll send that out hopefully soon. I probably realistically tomorrow evening. I'll put something together and send it out, and it'll be due on the Friday. Everything's due on Friday, December 17th. And that's for anything you have to make up or put in there. Due on Friday, December 17th. So now next week's class, I'll still be here next week. No new information, but if you have any questions on anything, you're going over some old work or something you want to talk about or whatever, I'll be here. But I won't have any new material. So the only material I'll have is whatever you ask. So if you don't have anything to ask me, there's no reason to come. You can come. I don't know, hang out. But so next week I'll have class at the same time. But again, it's only for tutoring. It'll just be for going over stuff. No new material. This is the last thing you'll see from this class. Any questions? Okay, well, I ran us over, but they were done. So let me save this, and I will use that as my guide. Okay. Any questions? All right, and I know some of you had turned work and I didn't get to going over it. I just saw it before class, and I didn't want to log in because I was afraid that it would mess up my Zoom meeting that was saving. It took a really long time. It took like an hour and a half for what should have taken like a half hour, but regardless. Okay, so if I don't see you again, great having you and have a good break. If I do see you, then I'll see you next week. All right, have a good night.
Thank you very much. Good night.
Thank you.
Thanks, guys.